Hi, my name is Solly. Welcome to Inksight. Here is the latest tax news. Today I'm going to explain the following topic: rental property tax essentials. Top tips and updates for 2023 you need to know. Depreciation, a powerful tax-saving tool. One of the most significant tax benefits for rental property owners is depreciation. By deducting the cost of a property over a set number of years, investors can reduce their taxable income and save money on taxes. In this series, we discussed the different types of depreciation, including straight-line, accelerated, and bonus depreciation, as well as how to calculate and claim these deductions on your tax return. Those looking to get a bigger deduction upfront often utilize a cost segregation study to identify and reclassify assets within a property, allowing property owners to accelerate depreciation deductions on certain items. Deductible rental property expenses. Operating a rental property comes with various expenses, many of which are tax deductible. In this series, we explored common deductible expenses such as mortgage interest, property taxes, insurance, repairs, maintenance, and property management fees. We also discussed the importance of keeping accurate records and receipts to substantiate your expense claims during an audit. Real estate example, including passive activity loss rules and real estate professionals. When it comes to wrapping your head around all of this real estate investing and taxes, many people get confused. To help paint a more clear picture, let's use an example to help illustrate the tax savings potential with a rental property utilizing a cost segregation study. Purchase price: $750,000, $150,000 attributed to land, $600K attributed to building, 20% down payment, $150,000. Cost segregation study: 5, 7, and 15-year property. $228,000 80% bonus depreciation in 2023, $182,400. 27.5-year depreciation. $372,000 or roughly $13,500 per year. In this example, you invested $150,000 but got a year one deduction of $196,000 that could potentially offset other income of yours. One thing to note is that passive losses can only offset other passive income. Essentially, if you have a rental property, passive, and you have a loss in it due to high depreciation, you can only offset that loss against other passive income, rental activity, or businesses you do not actively participate in, but you cannot use that loss to offset earned income, W-2, or non-passive capital gains. Those unused losses will be carried forward. Short-term rentals loophole. The rise of platforms like Airbnb and VRBO has made short-term rentals a popular investment strategy, and there is a unique loophole in the tax code that makes these favorable. We just discussed the passive loss rules and how you would need to qualify as a real estate professional to offset loss against your ordinary income, but there is one loophole to get past that, and that is short-term rentals. From a high level, if your average rental is 7 days or less, it qualifies as a short-term rental. Even though it is a rental property, since it is short-term, the IRS does not classify it as rental activity, and thus it is not considered passive. This means it is not subject to the passive loss rules, and you may be able to use short-term rental losses to offset your regular income, W-2, business, etc. In order to use a short-term rental to offset non-passive income, you need to prove that you materially participate in the activity. There are 7 tests that you can use to meet, but the most common one we see is participating in the activity for more than 100 hours during the year and more than any other individual. Real estate job or flipping. Much of what we are discussing here is related to rental properties, but if you are in the business of real estate earning ordinary income, you may want to look at an S-Corp. This would not be for rental properties, but rather real estate agents, flippers, contractors, etc. There will come a time that you want to sell a property of yours. It's important to think about the tax implications of that prior to the sale to ensure you are avoiding or paying the least amount in taxes on that sale as possible. More often than not, we see folks utilizing 1031 exchanges, charitable trusts, etc. in the scenarios. A 1031 exchange allows real estate investors to defer capital gains taxes when selling a property by reinvesting the proceeds into a like-kind property. Our podcast episodes covered the rules and requirements for a successful 1031 exchange, including timeframes, property identification, and the role of a qualified intermediary. Contact us today to learn more about rental property tax essentials. Top tips and updates for 2023 you need to know and how we can support your business needs.
Insight. Modern innovative accountants.